All right, next look at stock dividends. So stock dividends are when a corporation is issuing stock shares instead of cash. So there's a couple of reasons why they would do that. One is they want to manage the price of the stock out there in the market, and the other is they want to provide evidence of management's confidence that the company is doing well. Often stockholders obviously want cash dividends, but a stock dividend is going to allow you to have more stock so that later on you could have a higher cash dividend when they pay out cash dividends later on and you own more shares of that stock. So it's not a bad thing. All right. When we look, there are two different kinds. There's a small stock dividend, which is when you're distributing less than or equal to 25% of the previously outstanding shares. And there's a large stock dividend when you're issuing more than 25% of the previously outstanding shares. So we're going to look at how do we account for each of them. So we're going to start with a small stock dividend. When we record a small stock dividend, we have to keep in mind that it is being recorded by capitalizing retained earnings for the amount that's equal to the market value. So small stock dividend is equal to the market value. When we look at large stock dividend, it's going to be based off of the par or the stated value. So here it says that assume that Quest directors declare a 10% stock dividend on December 31st. The stock dividend of 1,000 shares, which is computed as 10% of its 10,000 outstanding shares, should be distributed on January 20th to the stockholders of record as of January 15th. So since the market price of Quest stock on December 31st is $15 per share, this small stock dividend declaration is recorded like this. So we're taking that 10,000 shares times 10% to figure out how many shares of stock we're issuing, and that comes out to 1,000. We use that market price, $15 per share, and we're distributing $15,000 worth of common stock. So that's the amount that's debited for retained earnings. The par value comes out of the common stock dividend distributable. So that's our liability. So we have common stock dividend distributable for 1,000 shares times the par value of $10 or $10,000. And then we have paid in capital in excess of par value. So the difference between that $15 and $10 is $5 per share times 1,000 shares is going to give us that $5,000. So that's our small stock dividend. When we look at how it's going to change on the stockholders' equity side, we can see that the stockholders' equity before the stock dividend, we had common stock of $100,000, paid in capital of $8,000, retained earnings of $35,000. So in general, the balance sheet changes in three ways when we have a stock dividend that's declared. First, the equity attributed to common stock is going to increase. So for Quest, it went from $100,000 to $110,000 for those 1,000 additional declared shares. Next, we see the paid in capital in excess of par increasing by the excess of market value over the par value for that declared shares. So that $5,000 increases that paid in capital in excess of par common stock account from $8,000 up to $13,000. Next, we're going to see that retained earnings decrease, showing the transfer of both the common stock and paid in capital out of retained earnings. So stockholders' equity, it does change by account, but the overall total stockholders' equity doesn't change when you look at that. So the next part would be the date of record. There's no entry required for the date of record, so there's nothing to do there. But on the payment date, January 20th, the entry would be Quest distributing the new shares of the new shares to the stockholders, and they're recording the entry by debiting common stock dividend distributable for $10,000 and crediting common stock $10 par value. All right, let's look at a large stock dividend. So a large stock dividend is based off of the par or the stated value of stock. So it tells us here that Quest has 10,000 shares of $1 par value stock outstanding. December 31st, they declared a 30% stock dividend. The stock will be distributed to stockholders on January 20th, and we're to do the December 31st entry. So we know that they're declaring a 10,000 share dividend. which they said that it's 30%. So if we look at this, we can see that they issued 30%, which is larger than that 10%. So that's going to make it a large stock dividend. So 10,000 times 30% makes it 3,000 shares times that $10 par value. And then we will get $30,000 that's debited to retained earnings, and we would credit common stock dividend distributable for that same $30,000. I do want to point out that it is saying $1 par value in this slide, but it should still be that same $10. So that's why we're using $10. That's an error in the slide. All right, the last one goes into stock splits. So we talked about cash dividends and stock dividends. The other thing that can happen in the retained earnings section is a stock split. So that's where we're distributing an additional share of stock, but they maintain their percentage of ownership. But what happens is the par value is going to decrease by the amount that's split. The number of shares will increase by the percentage that's split. So if it's a 2-to-1 split, that means that we're doubling the number of shares and we're cutting that par value in half. So that overall number doesn't change. What changes is how many shares you have and that par value. So the stock split is the distribution of the additional shares to the stockholders, and they still maintain that same percentage ownership, but they're going to have new shares of stock. So the par value of that is going to change. So after the split on a 2-to-1, the number of shares are going to be doubled and the par value will be cut in half. So we'll do an example of that in the Need to Know video that you can watch that kind of follows along to show you examples of stock splits, stock dividends, and also cash dividends. All right, so let's look into our next section, which is going to look at the preferred stock. So for preferred stock, it's just another class of stock. So we have common stock, and now we're going to have a second class of stock called preferred stock. There are definitely differences between common and preferred, especially when it comes to like what kind of rights they have. So let's look at just the basics of preferred stock. So it's called preferred because there is a priority over common shares when it comes to who gets dividends first. The preferred stockholders are going to get their dividends before a common stockholder would. And also, if the company were to be liquidated, preferred stockholders would get their share before a common stockholder would. So that's one of the differences. Another is that it doesn't usually have voting rights. So common stock gives you the right to vote and make decisions in how a company is running. Preferred stock typically doesn't, but because it doesn't, it typically has a higher dividend rate, and it's also going to give you the option to sometimes earn dividends every year, and we'll talk about that in the next part. So there's two different kinds of preferred stock. You can have cumulative preferred stock or non-cumulative preferred stock. Cumulative is just that. It means that the dividends will accumulate until they are actually paid. With non-cumulative, if there's not a dividend declared that year, they don't owe you for the previous years, or they just owe you for the years that they actually declare a dividend. So they show us here example of the stockholders' equity section, and it shows you that the board is declaring a $5,000 dividend in 14. And then in 15, they're declaring and paid cash dividends of $42,000. So we can see that the common stock is listed separately from the preferred stock, which is what we want to see. Common stock has a $50 par value. There are 4,000 shares authorized, issued, and outstanding. Preferred stock has a 9% dividend rate, a $100 par value, and they have 1,000 shares authorized, issued, and outstanding. So that just kind of shows you a little bit of the difference. So let's kind of walk through the breakdown of these dividends that they're offering in 14 and 15. So if in 2014 they declared a dividend of $5,000, well, preferred stockholders get theirs first. So it's all going to go to that preferred stockholders, and we'll see that in 2014 the common didn't get any. In 2015 they declared a $9,000 dividend. I apologize, they declared a $42,000 dividend. So 9% of the par value times the number of shares. So preferred stock is entitled to $9,000 of dividends every year. So if we're looking at that, that means that they would get the $9,000 in 2015, and that remainder of that $42,000 or $33,000 would go to the common stockholders. So that's non-cumulative. So that means that they didn't get the back dividend for 2014 because they are entitled to $9,000 per year. They only got $5,000, but they're not owed anything in arrears. So when we look at that, let's take a step back of how to calculate what preferred stockholders would be getting. So what we do is we take their 1,000 shares times the $100 par value times the percent of the dividend, and so that 9%. So that's where we get that $9,000 per year that preferred stockholders will be entitled to. So if we were looking at a cumulative, that means they're entitled to that $9,000 every year, even if a dividend is not declared in full. So we can see that in 14 there was a $5,000 dividend that was declared, so the preferred stockholders got all of that $5,000, but they were supposed to get $9,000. So since it's accumulated, they still have $4,000 dividends in arrears. So we have to kind of catch that up. So the next year when that $42,000 is paid, they get that $4,000 that's in arrears. They get the $9,000 from that current year that they're entitled to, and then the balance, that $29,000, would go to the common stockholders. So this is where you can see that there's an advantage to being a preferred stockholder because you're getting your dividends first. All right, the other part that can go along with preferred stock is it can be participating or non-participating. So participating preferred stock has a feature that allows preferred stockholders to share with common stockholders in any dividends paid in excess of the percent or the dollar amount on the preferred stock. That feature does not apply until common stockholders receive dividends equal to that preferred stock's dividend percent. And then the other one is non-participating preferred stock, and that's a feature that limits dividends to a maximum amount each year. So this maximum is stated as a percentage of the stock's par value or as a specific dollar amount per share. Once the preferred stockholders receive this amount, the common stockholders receive any and all additional dividends that are declared. So typically that's what we see most common is non-participating. So that non-participating is what's typically to be considered normal. And then the last part just closes out with looking at, why would a company issue preferred stock? So when we're looking at that, there's a few reasons. Number one, they want to raise capital, but they don't want to give that vote or that control out. So they declare it as preferred stock. It's also going to increase the return that's earned by the common stockholders. And the last thing is some investors may think that the common stock has a risk applied to it because preferred stockholders would get their benefit first. So they may be more reliant on that preferred stock because they're going to have the priority over those common stockholders. All right, our next section we're going to look at treasury stock.